Hey, everybody. Welcome to the What the Wealthy Do podcast, where we pull back the curtain on how the wealthy build wealth and show you how you can use those same strategies on your wealth building journey. I am your host, Stephanie Dorsey, and I'm also the CEO and co-founder of Margins Capital. And at Margins, we are providing access to women and people of color to an institutional quality portfolio of alternative investments. That is a mouthful. And today I went back and forth on where to place this episode, but we're just going to jump into it because everyone is on different investment journeys. And so today we're going to focus on what are some of the different avenues that allows you to invest in the private capital markets or in alternative investments. I am going to, after this, dig a little deeper on different asset classes in alternative investment space. But for those who are just like, girl, give me quick gatekeeping, just let me add them. That's what we're going to talk about today. And so before we jump in, I would be remiss, but I have to remind you all, this podcast is not intended to give financial advice. It only provides financial education. So this 15 minutes conversation is just intended to give you just enough for you to go out and start to do some research on your own. Okay, brief reminder, alternative investments or private capital markets. Remember we said there are a lot of nomenclature, a lot of synonyms, but they literally mean the same thing. And so private capital markets or alternative investments is anything that is not a stock, a bond, or cash. Anything that you cannot trade on a stock exchange or the public capital markets. So that includes everything from venture capital, private equity, commercial real estate, also private credit, infrastructure deals. So when all these companies, AI, it needs to be powered by data centers, which is commercial real estate, but also we are going to have to improve our water and our electricity grid to be able to support all of these AI enhancements. That is an infrastructure investment play. Also, if you think about natural resources, you think about lumber, oil, and gas. Those are all alternative investments and they're all natural resources. And you think about fine art, music catalogs. You see people trying to get their masters. It's because they make money on the licensing rights. They're also, people are selling their masters. I think Nelly sold his for $100 million or something like that. I don't know, whatever. But yes, that is also an alternative investment. If you think about movies, plays, and things like that, sports memorabilia, luxury good, like luxury purses and watches and things of that nature, vintage cars, those are all types of alternative investments. There are 4 investment vehicles that we're going to talk about today. The first one is the fund model, and we're going to talk about that. We're also going to talk about the SPV or special purpose vehicle. Sometimes it's also referred to as a syndication. We're going to talk about that model. The third is angel investing or crowdfunding. And then the last one is direct investing. So the first one that we're going to talk about are funds. A fund is basically a pool of money that comes from different investors that's managed by one or a group of professionals. So a lot of your big companies, even down to smaller companies, will raise a fund to invest in a specific thing. And those investors in that fund are referred to as limited partners, right? Because the fund model, there's a general partner. That's the person or persons who are managing the fund. So they're the general partner. They make all the decisions. They decide where to invest and how much to invest in a particular opportunity. And then the limited partners are all of the individuals or entities, because you can have a company or pension plans, university endowments, insurance companies. They will invest in a fund and they're a limited partner, but individuals as well, limited partners. So the wealthy like investing in funds because there is added diversification. So if I'm a fund manager and I'm raising a fund, I am going to be investing in multiple different things. So you might invest, if I have a venture capital fund, or actually let me just speak specifically about the private equity fund that Margins Capital has invested in. in, he is going to invest in 8 to 10 companies that align with their investment strategy. I get diversification from investing in that fund. Also, it's managed by a professional that knows the space and that is actively managing my money. And so I don't have to do that. I'm outsourcing to him to invest in private equity on Margins Capital's behalf. And then when you invest in a fund, also you're investing because you're like, that fund is out there beating the pavement and they're trying to get access to different deals that I might not have access to. Because again, that's not my job. That's the general partner's job to go out and make sure they're getting access to the best deals. My job is whatever I do from day to day, right? So I'm outsourcing this level of access and care to the general partner or the fund manager. Now, the trade-offs for investing in these funds, and I say this all the time, these are barriers to entry that make it a little difficult to invest in private capital markets. The first one is you have to be an accredited investor. And to be an accredited investor per the SEC guidelines, if you're a single person, you have to make $200,000 a year for the last 2 years. And if you're a married person, you as a couple have to be making $300,000 a year for the last 2 years. Or you have to have a net worth of $1 million. That's a pretty massive barrier. Another one is some of the average fund, the cost of their investment minimum is pretty high. And it's somewhere around $100,000 to $200,000 per individual limited partner. If you're an institution, it's going to be higher. So for instance, the fund that my business partner and I invested in is a venture capital fund. We invested $200,000 in it over the course to be called. So there's capital calls. So we didn't have to write a check for $200,000, but we committed that every time they say, I need you to write me another check, then within a couple of days, we're going to wire them money. And so over the course of 5 years, we've committed to wiring them $200,000. Another trade-off is, and this is not just limited to funds, this is really about investing in the private capital markets as a whole, but there are what's called lockup periods. So when you invest in the private capital markets, you know that you're investing for the long haul, right? So especially venture capital, private equity, we'll talk a little bit more about that. Your cash is going to be locked up for about 7 to 10 years. But even if you invest in real estate, which is typically your cash is locked up for about 3 to 5 years, unless it's like 2022 or 2023 and you invested in a fund that invested in office buildings and it's post-COVID and the value of office buildings has tanked. And so people are holding on to those assets for a lot longer because they don't want to sell them for a loss. So these lockup periods are recommended, but your fund manager is going to hold on to that asset for as long as possible to ensure that it gets the type of returns that it sought out to get at the beginning when it was fundraising. And then lastly, the fees for alternative investments are indeed higher than the fees associated with investing in public capital markets. So they have a fee that is referred to as 2 and 20. So it's 2% of all the assets under management per year for the life of the fund. And then they get a 20% bonus, right? So assuming they hit it out the park and they exceed what's called a hurdle rate, that number that we're like, okay, as long as we return more than X percent, we're going to share in the revenues. So for instance, you invested in Stripe and in a fund that invested in Stripe goes public, it goes crazy, and you make $1 million on your investment, then they're going to take 20% of that $1 million and you're going to take 80% of it. So you get to keep 800,000 and they get to take 200,000. I know that sounds crazy, but it's not. Like, it's the name of the game, and that's how, like, you just happy to be in there. Like, because 800,000 is pretty massive, right? So you can cut off your nose to spite your face and say, oh, well, I don't want to share and give them 20% of my returns, or you take the massive win, even though you had to pay to be in the game. All right. So similarly, a special purpose vehicle or an SPV or a syndication is a pooled resources. But the difference is, instead of like like a fund where you're going to make multiple investments. A syndication or SPV is created to just make one investment. So for instance, OpenAI that owns ChatGPT, they're doing a fundraise. You want to get in there. You want to invest on the secondary market. The minimum investment to invest in the secondary market is $100,000. You can get 10 of your friends together and you each put up $10,000 and create a entity for the sole purpose of buying shares in OpenAI on the private capital market. So investors like SPVs because the investment minimum can be a lot smaller than investing in funds, right? I just gave the example of investing $10,000 instead of the $200,000 that Michelle and I invested in the VC fund. You know exactly what you're investing in because you're investing in one deal as opposed to potentially relying on a GP to manage and make all the investment decisions on your behalf. And even though you didn't invest in a fund, you can still get access to certain deals that might be closed off to individuals, again, because for whatever reason, but likely because the investment minimum is cost prohibitive. The trade-off though is you don't get diversification because again, you're investing in one deal. You're still subject to management fees, although they will be likely smaller than what is associated with a traditional fund. And you have to rely on whoever that lead investor is. You have to rely on their due diligence as opposed to an organization that might have a more structured due diligence. So you just need to make sure that dude or that person or that woman who has put the syndication together knows what they're doing in terms of due diligence and they're evaluating and investigating whatever investment that you all chose appropriately. Okay, let's talk about 3, angel investing. So angel investing is typically when you invest directly into a startup, likely in the earlier stage of that company's life cycle. It's a wonderful way for companies to make money and take on investors outside of their friend and family rounds. And then sometimes friends and families can be considered angels, but it allows them to take money from individuals rather than institutional investors like venture capital funds or banks. But here's the thing, very important. Most startups fail. Like I want to repeat that. Most of them fail. So you really need to be careful when you invest in a startup, especially if you're investing as an individual angel, like a solo angel investor. So you really want to make sure that your diligence is tight. But even still, with all the diligence there is, when you're in the beginning and you're pushing a boulder up a mountain, it is harder to do without momentum, right? And without money, right? So just be really, really thoughtful. You never want to put all your eggs in one basket. And as an angel investor, those check sizes should be much smaller, $1,000, $5,000, or something like that. They should be much smaller than $10, $15, $20, $25,000 checks, unless you're a baller. Actually, unless this is your business and this is what you do. Again, I talked about this with venture. You might not see returns for 7, 10, 15 years. So your money is locked up. You're not going to get this money back until that company makes it or don't make it. And then you definitely ain't getting it back. So there are a lot of platforms, actually public platforms, that you can go out and you can just Google that allow you to invest even as a little as $100 into companies. I'm not going to endorse any of those platforms, but if you Google it, you will find them. Also, I would suggest, again, you want to do your due diligence on the platform as well as the company that you're considering to invest in. So ask around, see if people have invested and used that platform. Go on to Reddit, go on, look at their Google reviews and things of that nature, just to make sure that platform is reputable. Lastly, these platforms, sometimes they require you to be an accredited investor, but some of them don't. There's this phenomenon that's happening in terms of democratizing alternative investments that are allowing folks, and even with crowdfunding platforms that are allowing you to invest without being an accredited investor. So again, do your research to make sure, A, whether or not you are an accredited investor, and B, whether or not the platform that you choose to invest in requires that. And lastly, we talk about direct investing. And this is a really good example. It can be done on a very small stage if you decide to buy an apartment or even buy a multifamily apartment apartment complex, a 3-unit or 2-unit, a duplex or whatever, you can get a FHA loan, and then you can manage that asset yourself or get a management company. But that is your direct investment into that asset. Alternatively, on up to like you got a lot of money and you decided that I am investing in whatever X thing, you get a windfall and you want to invest. For instance, my business partner decided to invest. She created a company. She created a cannabis company and she made the primary financial investment. That is considered a direct investment into her cannabis company. So that's basically what direct investment is. Again, it generally requires a larger size investment on your part. You can take on partners, but it's on you. You have full control. You don't have any management fees, and you can structure the deals how you like them. But the trade-off is you have to do all the due diligence yourself. There's a high barrier to entry. Like I said, you have to bear all the costs to get in the game. And there's very little diversification unless you yourself decide to invest in multiple deals. So we started this episode talking about the barriers to entry, and to choose which of these vehicles is right for you. I tell everyone, really it's about know thyself. You need to understand who you are, your risk tolerance, your goals. Do you want to be managing all this by yourself, or do you want to be a passive investor? You need to understand your financial goals. Are you okay with paying the fees that are associated with outsourcing this investment, or do you want to do it all yourself? You also need to understand how much money you got. Like, while a lot of leaders now are suggesting that you want to add alternative investments to your portfolio, you need to be thoughtful that you have the capital to allocate to these assets. You do not want to be investing with your rent money. You need to be investing with discretionary funds and or your retirement. So you can be using your 401k or your self-directed IRAs and things of that nature. And remember, the wealthy don't just pick one. They're not all in on one fund. That's not, I'm worth $30 million. I put $15 million in this one fund. They're investing across a number of different asset classes in the private capital markets ecosystem. And so this is something that you should consider too. How do I diversify and get the most bang for my buck, which is diversification, if I decide to invest in private capital markets? So, all right, that's all for today's episode. Again, hopefully you understand there are 4 primary ways to invest in alternative investments. That is your fund model, SPV, direct investments, crowdsourcing / angel investing, and all of these things are absolutely available to you. Do not be intimidated by this. We are beginners. At some point, you're a beginner at everything. Even when you first started walking, you were a beginner, right? But this stuff is not beyond you. You can absolutely understand it, learn it, and master it even. And you should, because your wealth is way more important than your job even. Managing your wealth and building your wealth should be your number one job. So let me get up off my high horse. Thank you so much. I hope you found this episode helpful. And if you did, please share it with a friend. And don't forget to subscribe and or follow us on wherever you like to get your podcasts. We're on YouTube, Spotify, and Apple. And we'll see you next week where we're continuing to talk about the private capital markets or alternative investments. Next week, we're going to be talking about private equity, which is like the big daddy of them all. So see you.